Can a really great earnings report actually overcome some seriously negative market feelings? We're going to take a deep dive today into LMND, ticker LMND. Welcome to D-Risk, a podcast where we provide a no-nonsense analysis of stocks.
And yeah, we're setting the stage here based on our research capture November 5th, 2025. The overall picture, the macro environment, it's adding a bit of caution, wouldn't you say?
Definitely. The NASDAQ, the S&P 500 futures, they're pointing a little lower this morning. Seems like the market's kind of holding its breath before some big economic reports drop later today.
Right. So let's get into LMND itself, the fundamentals.
Let's do it. And the numbers, well, they look pretty sweet. LMND just reported, and it's a clear win. They posted a loss, yes, but smaller than expected. And they really crushed the revenue forecasts, pulled in $194.5 million when the street was looking for about $185 million.
Okay.
But the really big news, I think, is that they actually raised their full-year guidance.
And that is, a powerful signal, a tangible catalyst. It basically tells the bulls, look, the path to profitability, it's speeding up. Our AI model, it's working.
Right.
In isolation, this quarter really should challenge anyone bearish on the stock.
But here's where it gets, well, really interesting to me. If the earnings were so good, why haven't we seen like a massive reaction? A big short squeeze, maybe?
Exactly.
Wall Street analysts, they don't seem totally convinced yet on the long-term story. Our research shows analyst consensus is still pretty skeptical. 80%. 8 out of 10 analysts are sitting at hold or even sell.
And that skepticism, you see it reflected directly in the market dynamics. The shorts, they're not necessarily focused on just one good quarter's revenue.
Right.
They're making a bigger bet, maybe, that the fundamental economics of this AI insurance model, well, that it won't scale profitably in the long run.
And they are really committed to that view.
Oh, incredibly so. A huge 28% of the company's shares that are available to trade the float is sold short. Think about that. Nearly a third of the stock is betting against it. That's a massive wall of worry for the stock to climb.
And you see this fear mirrored in the options market too, right? The put-to-call ratio is sitting at 1.09, which, for context, that's showing more traders are buying puts, downside protection, than calls. It's a significant tilt towards fear.
But here's the contradiction. Despite all this bearish betting, the actual chart, the technical picture, looks undeniably bullish.
Okay, how so?
Well, both the long-term and short-term trend indicators, they're bright green. It's confirming a clear pattern of higher highs and higher lows, an uptrend.
Wait, okay, so the trend is up, the earnings were great. But you're saying the technicals are also showing some fatigue.
That's the catch. Our charts are flagging things like buyer exhaustion. Yesterday's price action, the candle pattern, it hints at a potential reversal, even with that overall positive momentum.
Huh. So does that mean the bears might actually be right to ignore the strong quarter, that the chart fatigue is the real signal?
Not necessarily right, but it definitely shows how much weight that bearish sentiment carries. You've got this underlying bull trend basically running smack into this huge wall of short sellers.
Okay.
So putting it all together, you've got a mixed macro backdrop, fantastic earnings, really, really negative sentiment, but a bullish trend that's looking, well, tired. Our research points us towards a cautiously bullish outlook here.
Cautiously bullish, because the earnings news is just too strong to ignore completely.
Exactly, but that short position is just too big, too entrenched to simply dismiss either.
So the biggest immediate risk then is clearly that huge 28% short interest.
Without a doubt.
And the key battle lines for the next few days, maybe weeks, it comes down to specific price levels, right? For the bulls, what's the target?
They absolutely need to push price above the recent high. That level is $61.49. They need to get above it and, crucially, hold above it.
And why is that $61.49 so important?
Because that's likely the trigger for a short squeeze. If the bulls can break and hold above that, it starts putting serious pressure on those short sellers. They might be forced to buy back their borrowed shares to limit losses, and that buying just fuels the price move higher.
Got it. And the flip side, where does this cautiously bullish idea fall apart?
The line